Well, I'm joined now from New York by Gillian Tett of the Financial Times and by Irene Aldridge, author of High Frequency Trading, a practical guide to algorithmic strategies and trading systems. Gillian Tett, first of all, do you think high frequency trading is a danger to the markets?
Well, I think it's a danger at the moment in the sense that very radical changes have occurred in the way that equities are traded. They're very poorly understood. I mean, the fact that the US regulator has been studying this for months and still doesn't quite know what happened on May the 6th is truly stunning. And unfortunately, it's not just a question of the markets being computerized. The actual nature of where they're being traded has also changed. No longer are they on regulated exchanges, they're in these dark pools too. So you have some very rapid changes where, frankly, the traders are well ahead of the regulators.
Irene Aldridge, is it a danger that the traders are ahead of the regulators?
Well, first of all, the regulators, I want to point out, they're responding to a lot of political pressure. A lot of people came in the wake of really the last 2 years of problems that we've had in the stock market. And they're pressuring their representatives to do something about it because a lot of people's pensions funds got wiped out. And, you know, just because of the recession and because of structural changes in the market, traditionally people used to use technical analysis and fundamental analysis, as somebody just pointed out, to make decisions about which companies are better to buy and sell. Now everything is moving towards quantitative investing and using complicated mathematical strategies to actually buy and sell. And I think this is where people are feeling like they don't understand what's happening with the market and why the markets are so volatile, and they're responding to different events. And this, I think, creates a lot of fear, and high-frequency trading is definitely the most unknown of all these new changes in the markets, and it's the most prominent since last year, since Goldman Sachs arrested one of their employees. But
you've written a guide to it. Presumably you think it's a good thing, that it's a kind of irresistible move forward to even faster and faster trading.
Well, first of all, about the faster and faster trading, there are a lot of misperceptions in the market. Some people think that people actually trade in microseconds. You know, to make a trade, you have to put the money into the market, let's say a stock, even the most liquid one, the S&P 500 ETF. And then you have to wait for the stock to move at least 1 penny up or down. Otherwise, you just can't make the money. When people say people are making fractions of pennies, what they mean is on average, sometimes they gain some, sometimes they lose some. So on average, they make a fraction of a penny per trade. But the minimum you can make is 1 penny, and to make this S&P 500 move 1 penny, you have to, on average, wait for 2 seconds.
2 seconds, Gillian. 2 seconds, Gillian Tett. Is it just an extension of the frenetic nature of trading, and in the 21st century, it's algorithms?
Well,
this is to Gillian. Sorry, Gillian.
But it is to agree, but one of the key things to realise is that essentially this is a game for hedge funds, for banks, for experts. It's not the kind of stuff that your mum and pop investor can play in. And so there's a tremendous inequality of power here in the markets right now. And that's reinforced by the fact, as I said before, that trading's moving off the kind of regulated exchanges that mum and pop investors can see onto these so-called dark pools, these private pools, where banks are essentially dominating the show together with trading funds.
Tell me, Gillian Tett, do you think there are mechanisms that could be used, for example, a tax on trades, that could essentially slow things down?
There are ways to slow the market down, and regulators are looking at that right now. And frankly, one of the problems is that people who defend this say that, well, it's great because you get more liquidity in the markets. One of the issues is you get liquidity in the markets in good times. When they freeze, what you tend to have is essentially an even worse situation, as we saw on May the 6th.
Irene Aldridge, what do you say to that?
Well, liquidity, first of all, by definition, is the amount of supply and demand that's available in the market. So the more people are buying and selling, the more liquidity there is, just by definition of liquidity. Now, I have a book actually coming out, which is the Quant Investor's Almanac, and this explains specifically to mom and pop investors what the new strategies are in the very plain English. And it's not about high-frequency trading necessarily, but mom and pop investors can use quant trading strategies very successfully in lieu of previously fundamental strategies and the previous.
Gillian Tett.
I do find it somewhat terrifying to think of mum and pop sitting at home with a computer, you know, trying to play these markets. I mean, at the moment there is such an unequal gap in knowledge and information that I think actually that would be very dangerous.
But Gillian Tett, you've also been talking about the idea that the brain is programmed in two ways, one to go very fast and one to be a bit more cautious. Explain that.
Well, I think that no, it's more the argument that actually there is a case to be said that actually, what is the equity market for? Is it purely a speculative vehicle, or actually is there a case for people to look at the fundamentals of companies when they decide to buy and sell? But one of the problems is, for example, that the loss of market makers, the loss of people who will actually be committed to make markets, provide liquidity, has had big structural implications that regulators still don't properly understand.
Thank you both very much indeed. And on the Review show tomorrow night, Gordon Gekko will be back. We'll be reviewing Oliver Stone's Wall Street 2, Money Never Sleeps. Africa's most populous country, Nigeria, is about to celebrate 50 years of independence.